Thanks for checking out another clip of the Cashflow Contractor. We'd love to have you as a part of our audience. Click subscribe wherever you get your podcast. I want to kind of see through this whole electrical contractor story because it is really cool what you were able to accomplish. So what was the first thing that you kind of go through? You said that you got the accounting department in order, you got the financials accurate into a place where the business owner would actually could make sense of them.
Yes.
What kind of happened from there? You were there for 4 years. What did that process look like over those 4 years?
Yeah. So once we got the financials, it takes a lot of work to get the financials accurate. And I don't want to undermine that process, but once we got the financials accurate, then we were able to intelligently talk about the financials and talk about the growth of the business. And one area was we wanted to look into the distribution center. So we were like,
Mm,
okay, let's build a business model of us servicing and bring building distribution centers. And just for that example, I mean, you think of all the Amazons, FedEx, and WalMarts, those distribution centers. We became one of the number one electrical contractors to put those in place. We would not be able to do that if we did not have a financial plan. And
What,
uh,
so how did you come up with that decision? Hey, we are going to focus on distribution centers. Was it that you had one and it was very profitable? Like, hey, we need to do more of these. What was it?
yeah, so we did do one, and we and to your point was profitable, but the profit margins were actually less than our normal business. But we were able to figure out a way to still be profitable at a lower margin. That's not something I always promote, but
Mm,
we're just in that area in the distributions, we were able to grow in 4 years, just that division, 30 million. And if you can grow 30 million and still make 10% to your bottom line, that's 3 million to your bottom line. So
right.
um, that would be a hard decision to make, to do a less profitable job. Again, that's not what I always recommend, but we are able to model it where that, going after this, we could actually be more profitable.
Yeah, if you got the volume in, it would make sense. Gotcha. Okay. Very interesting. So you decide that you're going to go after distribution centers. What else is kind of going on?
So a couple things, we acquired a couple companies.
Okay.
That was another approach that we took on. We figured, again, strategically, we identified certain clients that meet certain metrics that we knew that we could, I say, gobble up. So we could gobble up a $5 million company and put it up in our umbrella in a month or two, and all of a sudden that 5 million company is worth 10 times more just because it's part of our company and we have our infrastructure. So,
And I
um,
imagine you were buying at a lower margin. I mean, multiple, like three or four,
oh,
and
no,
more than that. Less.
Less.
Oh, and then selling for 12,
yes,
uh, which you didn't know for certain, but somebody had an idea, right?
yes, yeah.
So yeah. Oh, cool.
That's
Now,
great.
well, we're not totally talking about that, but if we have time to go back to the difficulties of acquisitions, but Cleo, keep going.
Yeah, keep going. So, you're strategic on your project because you have the accurate financials. You can be strategic about what projects to choose rather than just bidding whatever comes your way. You're saying, hey, distribution centers is the model. If we can get this to, this many projects a year, then it makes total sense for us. It's streamlined. It's a large project. I'm assuming the distribution centers are a very large dollar amount per project where you can keep all your guys busy. Um, is there also kind of a maintenance or service component to those distribution centers?
Um, oh, something I mentioned as well is like we also presented to refinery plants maintenance agreements where we would bring people on site and basically they would be their employees. And it was, it's another model where it was a lower rate, but we had zero downtime and we had guaranteed money. And what we did is we created 3 to 5 year contracts with these plants, and with guaranteed rates, which would give us guaranteed money. So even, when the economy would, the construction economy would take a tank, we were diversified and we're in these other plants. And, that helped us out in a couple of situations. But having the maintenance agreements also mean we had reoccurring money so that when we did exit the business, it was another factor of getting a higher multiple.
Yeah.
Yeah. No, that's great. That's great. Okay. So we've mentioned getting this higher multiple. What were some of the other things that you were thinking about to be able to get that higher multiple? You talked about having, predictable revenue, recurring revenue from these maintenance contracts. Yeah. You've gotten a larger dollar amount of projects coming in, right? We've increased our revenue, which helps a little bit too. Not always, but if you're profitable, it's really helpful.
Yeah.
What else? What are some of the other things that you've done?
Yeah. A couple other things. One was that, we had an in-house recruiting, we had in-house apprentice program. So, as we had our growth model, we had the model to actually bring in the people to grow our business. That was a big factor. And then, the other factor is something that I do work with all of our business owners is getting out of the business. So a lot of times, you're to sell your business is going to be so much more attractive if you're not in the business running it every day, because another person that's going to buy your business, maybe they don't want to be the CEO of your company or the COO or HR. You want a business that kind of operates by itself. So in this process of the business owner exiting the business, so we grew the business from 30 million to 90 in 4 years, and in that 4 years, that business owner was working 60 hours. When we were at 90 million, he would come in a couple hours a week and play around in the shop
Wow.
just to make sure
And
that
this is the son,
my
not the father, right?
yeah, this is the father.
The father, but the son was
Yeah.
the CEO. What was the son doing at this point?
Yes. The son was the CEO at this point.
Okay, gotcha. Very cool. Thanks for checking out a clip from the Cashflow Contractor. We have full episodes where we go deep on topics that help you grow a construction business that runs without you, so you can have less stress, more time, more money. Now, we've got other videos, other clips, but if you want to check out the full episode for this clip, you can click wherever our editor put it. It might be here, might be there, might be over my face, I don't know. But thank you for checking us out. We'd love to have you as a part of our audience. So subscribe or check out a full episode wherever you get podcasts.